5 signs you are ready to start investing in the stock market. Diving into the stock market is like embarking on a journey toward financial growth, where preparation and confidence can turn your money into a powerful tool for building wealth. Whether you're in your 20s, 30s, or beyond, the idea of investing in stocks can spark excitement about creating a secure future or achieving ambitious goals. It's not about jumping in blindly or chasing quick riches. It's about knowing you're ready to navigate the market's ups and downs with strategy and resilience. The good news: your financial habits, knowledge, and mindset send clear signals about whether you're prepared to start investing, offering a roadmap to make your money work smarter. In this article, we're exploring 5 research-backed signs, grounded in financial expertise from sources like the U.S. Securities and Exchange Commission, SEC, and the Journal of Financial Economics, that show you're ready to invest in the stock market. By the end, you'll know exactly what to look for and how to strengthen these foundations to invest with purpose. Stay with us until the end, because you might be closer to stock market success than you think, and small steps can set you on the path to prosperity. Let's get started and uncover what your financial readiness is telling you about your investing potential. Sign 1. You have a stable emergency fund. One of the most critical signs you're ready to start investing in the stock market is having a stable emergency fund, a cash reserve to cover unexpected expenses without derailing your finances. According to a 2021 report by the Consumer Financial Protection Bureau, CFPB, an emergency fund covering 3 to 6 months of living expenses reduces financial stress and protects investments from premature withdrawals. If you've got a safety net, you're ready to invest with confidence. Imagine 2 individuals, Mia and Ethan, both 28 years old. Mia has $12,000 saved in a high-yield savings account, enough for 6 months of rent, food, and bills, allowing her to invest without fear of emergencies. Ethan, however, has only $500 saved, living paycheck to paycheck, and plans to invest his spare cash. He thinks he can handle surprises, but what he doesn't realize is that his lack of a fund could force him to sell stocks at a loss during a crisis, while Mia's cushion keeps her investments intact. Why does an emergency fund matter? The stock market can be volatile, and dipping into investments for emergencies, like medical bills or job loss, can lead to losses or missed growth. The CFPB notes that those with emergency funds are 40% less likely to face financial hardship. A fund ensures you invest for the long term. The good news: you can build one now. Save $1,000 as a starter fund, then aim for 3 to 6 months expenses, $5,000 to $20,000 for most. Use apps like Ally for high-yield savings, 2% plus interest. Cut one expense, like subscriptions, to save $50 monthly. If your fund is small, don't invest yet. Add $100 this week and automate savings. Ask yourself, do you have a stable emergency fund, or are you vulnerable to surprises? A safety net today secures your investments tomorrow. Sign 2. You've paid off high-interest debt. Paying off high-interest debt, such as credit card balances with rates above 15%, is a clear sign you're ready to invest in the stock market. According to a 2020 study in the Journal of Financial Planning, eliminating high-interest debt before investing yields a guaranteed return equivalent to the interest rate, often outpacing market gains. If you're free from costly debt, you're poised to grow your wealth. Picture 2 colleagues, Ava and Noah, both 32 years old. Ava has paid off her $10,000 credit card debt at 18% interest, freeing up $300 monthly to invest in stocks. Noah carries $15,000 in credit card debt, paying $400 monthly in interest, yet wants to invest $200 a month. He thinks he can juggle both, but what he doesn't realize is that his debt's high cost could outweigh market returns, while Ava's debt-free status maximizes her investing power. Why does paying off debt matter? High-interest debt erodes wealth faster than stocks typically grow. Average S&P 500 return, 7 to 10% annually. The Journal of Financial Planning found that paying off 20% APR debt is like earning a risk-free 20% return, far safer than stocks. Clearing debt frees cash for investing. The good news: you can tackle debt now. List debts and prioritize those above 10% interest. Use the avalanche method, pay minimums on all, then extra on the highest rate. Consolidate via SoFi for lower rates if needed. If debt lingers, don't invest. Pay $50 extra on one balance this week and track progress. Ask yourself, have you paid off high-interest debt, or are you still burdened? A debt-free foundation today boosts your investments tomorrow. If you're finding these insights inspiring, Please comment number 2 below to let me know you're here, and consider subscribing with notifications on for more content like this. Let's move on to the next sign. Sign 3. You understand basic market concepts. Understanding basic market concepts, stocks, diversification, risk, and returns, signals you're ready to invest in the stock market. According to a 2019 SEC Investor Education Report, individuals with fundamental market knowledge are 30% more likely to make informed investment decisions, avoiding costly mistakes. If you grasp the basics, you're equipped to navigate the market. Consider two friends, Sophie and Lucas, both 30 years old. Sophie has studied stocks, knows index funds spread risk, and understands that markets fluctuate but grow over time, giving her confidence to invest. Lucas, however, knows little beyond stocks make money, assuming he'll learn by doing. He thinks knowledge isn't urgent, but what he doesn't realize is that his ignorance could lead to poor choices, like chasing trends, while Sophie's understanding guides her to smart investments. Why does market knowledge matter? The stock market is complex, and uninformed investors risk losses from scams, overtrading, or panic selling. The SEC notes that basic literacy, knowing terms like P/E ratio or ETFs, builds discipline. The Journal of Financial Economics found educated investors earn 1 to 2% higher annual returns. The good news? You can learn now. Read The Intelligent Investor by Benjamin Graham or take a free Investopedia course. Learn 3 concepts: stocks, ownership shares, diversification, spreading investments, and compounding, growth over time. Practice with a $1,000 virtual portfolio on TD Ameritrade. If you're clueless, don't invest. Study one concept, like ETFs, this week and test your knowledge. Ask yourself, do you understand market basics, or are you guessing? Knowledge today powers wise investments tomorrow. Sign 4. You have a long-term financial goal. Having a long-term financial goal, such as retirement, a home purchase, or financial independence, indicates you're ready to invest in the stock market. According to a 2021 study in the Journal of Behavioral Finance, goal-oriented investors are 25% more likely to stay disciplined, avoiding impulsive trades. If you're investing with a purpose, you're set to grow wealth steadily. Think about 2 co-workers, Olivia and Mason, both 35 years old. Olivia aims to save $500,000 for retirement by age 60, investing $500 monthly in a diversified portfolio to reach her goal. Mason wants to make money, but has no specific target, buying stocks randomly. He thinks goals are restrictive, but what he doesn't realize is that his aimlessness could lead to erratic decisions, while Olivia's clear goal keeps her focused. Why do goals matter? The stock market rewards patience, with average returns of 7 to 10% over decades, but short-term volatility can tempt rash moves. The Journal of Behavioral Finance found that goal-driven investors stick to plans, maximizing compounding. A goal aligns your strategy. The good news? You can set one now. Define a target, e.g., $200,000 for a home in 15 years. Use a calculator like Vanguard's to estimate monthly investments, $300 at 7% for 15 years. Write your goal, I'll invest for X by Y. If you lack a goal, don't invest. Draft one this week, like saving for a child's education, and plan contributions. Ask yourself, do you have a long-term financial goal, or are you investing aimlessly? A clear purpose today grows your investments tomorrow. If you're feeling motivated by these ideas, please comment number 4 below to let me know you're here, and consider subscribing with notifications for more inspiring content. Let's move to the final sign. Sign 5. You're comfortable with some risk. Being comfortable with some risk, accepting that stock prices fluctuate but can grow over time, is a transformative sign you're ready to invest in the stock market. According to a 2018 study in the Journal of Financial Economics, investors who tolerate moderate risk earn 2 to 3% higher returns annually than overly cautious ones, as they embrace growth opportunities. If you're okay with market ups and downs, you're ready to invest. Picture 2 neighbors, Chloe and Ryan, both 33 years old. Chloe invests in a balanced ETF, knowing prices may dip but trusting long-term gains, staying calm during a 10% market drop. Ryan avoids stocks, fearing any loss, and keeps money in a 1% savings account. He thinks safety is smarter, but what he doesn't realize is that his risk aversion could limit wealth, while Chloe's risk tolerance fuels growth. Why does risk tolerance matter? Stocks can drop 20% in a bad year but historically recover, averaging 7 to 10% returns over decades. The Journal of Financial Economics found that risk-tolerant investors benefit from market rebounds, while overly conservative ones miss gains. Comfort with risk aligns with stock investing. The good news? You can build tolerance. Take a risk quiz on Charles Schwab to gauge your comfort: conservative, moderate, aggressive. Start with low-risk funds, like Vanguard's Total Stock Market ETF. Reflect on a past risk, like a career change, to boost confidence. If risk scares you, don't invest. Practice with a $100 stock purchase this month to test your comfort. Ask yourself, are you comfortable with some risk or paralyzed by losses? Risk tolerance today unlocks stock market success tomorrow. Final thoughts. Now that you've explored these 5 signs, you have a stable emergency fund, you've paid off high-interest debt, you understand basic market concepts, you have a long-term financial goal, and you're comfortable with some risk. Take a moment to reflect on your readiness to invest in the stock market. Are you seeing these signs in your financial life, or are there areas to strengthen? The good news is that investing is a journey you can prepare for, and every step you take now brings you closer to building wealth and achieving your dreams. Start today by adding $50 to your emergency fund, paying $100 toward high-interest debt, or reading one chapter on market basics. Set a clear financial goal, like saving for retirement, and test a small investment to gauge your risk comfort. If the stock market feels intimidating, don't hesitate. Connect with a financial advisor via CFP Board, explore free resources like the SEC's Investor.gov, or join an investing community like Bogleheads. Your financial future is a canvas for growth, and building these foundations now will set you on a path to prosperity. Don't wait for the perfect moment. Take one bold step toward investing today, and watch your wealth soar over time.